The last exercise is to identify the irrelevant or misspecified cost. The ability to recognize irrelevant or misspecified cost is sometimes just as important to decision makers as identifying relevant cost. So we'll practice how to identify the irrelevant cost and the misspecified cost. And how do we know that the past cost, although sometimes good predictors of the future costs, are irrelevant in decision making? Then let's consider such past cost as obsolete the inventory and see why they are irrelevant to decision makers. Here you go. We have example, the part 1, identify relevant information, relevant cost, and irrelevant cost. Suppose General Dynamics has 100 obsolete aircraft parts in its inventory. The original manufacturing cost of these parts was $100,000. That is the original cost. Is that relevant? I don't think so. The General Dynamics can remachine the parts for $40,000 and then sell them for $50,000. That is one of the options. And sell them as scrap for $15,000. And then which cost is irrelevant or relevant? And which option is the best? Relevant information, we want to identify which is irrelevant and relevant. Expected future revenue, that is the future revenue that is relevant. So in the remachine and sell, then we can sell $50,000. There we go, the $50,000. But we need to consider the expected future cost of remachine the part spending $40,000. So negative $40,000 in cost. Accumulated historical inventory cost of $100,000 is a sunk cost, irrelevant information. We only consider the future cost. So the relevant excess of the effect excess of revenue over cost is just we can just sum up. We can just sum up all this relevant information. So $10,000. That is relevant excess of revenue over cost. And the scrapping case, how much is the expected future revenue, right? They sell them as a scrap for $15,000. So $15,000 is the relevant information. So accumulated historical inventory cost is irrelevant information. And then expected future cost. Do we have the future cost when we scrap? No. So the sum of this effect of scrapping is $15,000. Then let's calculate the differences between these two cases. Then expected future cost. Okay, we can save $40,000 expected future cost by choosing scrapping, even though the scrapping has the less the future revenue than the remachine and sell. So sum up. Then we can identify the $5,000 is more beneficial for scrapping in terms of the revenue, future revenue. So definitely we have to choose scrap. Then next, identify misspecified cost. Okay, let's assume that a new 100,000 machine with a 5-year life can produce 100,000 units a year at a variable cost of $1 per unit, as opposed to a variable cost per unit of $1.5 with the old machine. A sales representative claims that the new machine will produce total cost by 30 cents per unit after allowing 0.2 variable cost per unit for depreciation on the new machine. Disposal value of old machine is now 0. Is the new machine a worthwhile acquisition? Okay, so in order to understand this, the question, we need to calculate the old machine relevant cost per year basis. per year basis, and per cost basis. That is the relevant cost information to identify the misspecified cost. Okay, so here assume we have a new $100,000 old machine and the new machine. So old machine and new machine can produce 100,000 units, the same 100,000 and 100,000. Okay, and then variable cost per unit basis for old machine is 1.5, as indicated in the question. It's $1. That is a new old machine, and then the variable cost. What is the variable cost then? We can just multiple. Then total variable cost 150,000 for the old machine, and new machine is $100,000. So definitely new machine takes less cost than the old machine. Then how about the depreciation cost? Depreciation cost, that is the irrelevant information in old machine. As you learned in the previous exercise, the book value and the depreciation of the old machine is already forgone in the sunk cost concept. But the new machine, now in the annual basis, there's no the new machine cost $100,000 in this information. That means that we want to allocate the new machine, the value of new machine $100,000 in a yearly basis. So how much is the depreciation cost out of $100,000? Because it has the 5 years lifespan, so 100,000. The old machine cost divided by cost allocation, 5 years. So $20,000 is depreciation cost, but the old machine depreciation is the sunk cost, irrelevant information. So total relevant cost per year basis is now, how much is that? So you can just sum up of these two. Also, it's 100,000, 20,000 is the relevant cost per year basis for new machine. Now let's divide by the units produced per year, number of units produced per year, to identify the unit cost per unit, the relevant cost per unit basis. So we can identify, new machine has only $1.2 per unit compared to the old machine 1.5. Then we can definitely choose new machine. But now let's specify some specific information, the expected volume. If we specify some information, then we can produce some the different result, different decisions. So that's why it is the identifying the misspecified cost here. The old machine, I'm going to put now the unit number of units per year is now 30,000 units per year, because the sales personnel often boast about the low unit cost of using their new machines, but may neglect to point out that the unit costs are based on the outputs far in excess of activity volume of their prospective customer. So in this case, if the customer's expected volume is only 30,000 units per year, okay, if our customers ordered only 30,000 units per year, not 100,000, is too much the optimistic. Then let's be objective. Here, the old machine, 30,000. Now we have the specified information, 30,000 the unit per year. In this case, now I'm going to collect the same information. Then the variable cost in total for old machine is going to be 45,000. The new machine is only 30,000. Then we should consider the depreciation cost. Depreciation cost is 20,000. We already calculated, but the depreciation of old machine is irrelevant information. So the total relevant cost per year basis is just a sum up of this variable cost and depreciation cost. Then, okay, we got $50,000 of the new machine, and old machine $45,000. So now we can just compare the relevant cost per unit basis by dividing $30,000. Then 1.5, which is same, but here we have 1.67 is the total relevant cost per unit per year basis. So if we change it to specify the number of unit, at most 30,000 unit is the expected volume from the customer purchase. So now we have to choose definitely lower cost. What is that? Old machine. Okay. Then we have different result. Okay. See you in the next video clip. Bye bye.